Howdy folks, how you doing today? It's March 15th, 2012, and I wanted to make a short video to show you one of the trades that I'm doing for this month. For those of you who are members, I showed you a couple credit spreads that I had put on, so I'm going to go ahead and update those for you because expiration is tomorrow. The first one, before we get into the free trade, I'm going to just do this real quick for members. So the first trade was the CMG credit spread, and as you can see, that one fully profitable is going to expire tomorrow, so yeah, no problems there. ISRG was another one, and the March trade that I had put on, that one again is going to be full profitable. It's going to expire on Friday, so no problems there. Yesterday, and if those of you who are interested in a credit spread trade, I put the following trade on. I believe it was yesterday. Let's check real quick. Yeah, yesterday I put this trade on. Sell two 470 puts, buy two 460 puts for a credit of $1. And so got plenty of room here. That's not the purpose of this video, but for those of you who are looking for a credit spread trade, you can go ahead and analyze this one on yourselves and see if it's something you want to get into. The one I wanted to show you today is a calendar. And as you can see, this is the fill over here. So I just put it on a few minutes ago. Let's go ahead and take a look at the analyze. Okay, so this is what the trade looks like. Currently, McDonald's is trading roughly at around $98, give or take. And I put on a calendar at the 100 call. Now, why did I do the 100 call? Well, if we get and take a look at the chart on this one, we can see that McDonald's has been trending, and then all of a sudden they had a gap down here, which was not a friendly gap. I'm still upset about that gap because it hurt our option union trade last month, but nevertheless it did gap down, and now it is seems to be slowly moving up. I don't think McDonald's is going to go further down. I think it is going to come back up. So what I did was I put on basically a directional calendar trade at the 100 strike, and this puts my break-evens at about 97 and 102.75. Now, since I think McDonald's is going to keep moving up, the current price is right here, 97.99. This is going to continue to move higher and higher into my middle of the profit zone where most of my money can be made. But again, McDonald's can retreat, it can go down, so the adjustment on this trade is, if it does go down, it hits about the break even on the low side, which is around $97, I can go ahead and add a second calendar spread at the 95 strike, and I'm doing this one in puts. You can also do it in calls, see which one is cheaper. The puts are at 122, the calls are at 90, so hey, that's a lot cheaper, so maybe I'll do the calls on they're interchangeable. So if we go ahead and take a look at that, that moves my break even all the way from 97 all the way out to 93.34. So that's going to be my adjustment on the low side if it does go down there. If McDonald's keeps going higher in the next few days, this trade will make money pretty soon and will do well. If the stock goes down, then I'll have to extend by adding another calendar spread. And also keep in mind that if the stock does move down, the volatility in the stock should increase. So the volatility of the options should increase, and that will help my calendar trade, and that'll push this maximum profit line. It'll push it up a little bit higher. So now on this trade, I'm looking to make about 15%. I'm only doing it with $500 as an example. So if I was trading for a living, that's I got an email from somebody today saying that, hey, I can't make a living making a trade with that can make me only $50. Well, obviously, if you're trading for a living, you're going to be trading much higher in much larger amounts than I use for example. So that doesn't make a lot of sense to me. But even if you're trading much larger amounts, if you're not trading this $500 that I'm trading, if I was trading it for real, I might be trading $5,000 or $10,000 per trade. the trade is the same. It doesn't matter what the numbers are. That's a mental block if you that you have to get over as you start trading with more money. Some people are fine trading at $500, but then when they have $5,000 on the line, then they freak out. So that is a psychological mental block that you just have to get over. But in terms of the trade itself, it doesn't matter if you're doing it with $1, $1,000,000. This trade is going to be the same, and the adjustment is going to be the same. The only thing you have to keep in mind if you're trading with much larger numbers is getting the right fill, and that's something that we're not going to cover here. But um, again, I just want to show you a simple trade I put on in my personal trading account. This is real money, and I don't expect you to try this trade at home with your real money. I expect you to paper trade it. Haven't done any calendar spreads in a while. Market right now is good for calendar spreads because the volatility is so low. That helps a calendar because if the volatility does spike, then a calendar can make money very quickly. So it's the opposite of a butterfly spread, in which you want the volatility to be high and then you want the volatility to go down as you're in the trade. So the butterfly will make money quickly there. Calendar, it's reversed. You want the volatility to be very low and you want it to spike. You don't really want it to spike, but if it does spike, it helps the trade. So if you have any questions, feel free to email, and have a great day.